You ever see an analyst glance at a page of numbers and just instantly know the health of a company? Well, today we're going to build that exact toolkit. We are diving deep into financial ratio analysis. And trust me, by the end of this, you'll be reading a company's vital signs like a seasoned pro.
All right, let's put you in the hot seat. You're a brand new consultant, your client slides an annual report across the table, looks you in the eye, and asks one simple, yet completely terrifying question. So, is this company healthy? The pressure's on. Where do you even start?
Well, the answer isn't some single magic number. It's a full diagnosis. And to do that, you need the right tools. So right now, we're going to build that toolkit together, starting with the absolute basics: how to check a company's financial vital signs, just like a doctor checking on a patient.
I want you to think of financial ratios as your stethoscope, your blood pressure cuff. They're not going to give you the final answer on their own, but they tell you exactly where you need to look deeper. We're going to break down our diagnosis into 4 key vital signs: liquidity, solvency, efficiency, and profitability.
Okay, let's start with the first two. Think of this like ER triage. First, you have to ask, can the company survive the next few minutes, the immediate future? That's liquidity. Then you ask, what's its underlying long-term condition? That's solvency. So the very first question is always about immediate survival. Like, right now, today, can this company turn its assets into cash fast enough to pay all the bills that are due within the next year? This is the most urgent test of financial health, period.
We've got 3 main tools in our belt for this. The current ratio is the broadest look. The quick ratio, which people also call the acid test, is much stricter. It asks if you can pay your bills without having to sell a single piece of inventory. And the cash ratio? That's the ultimate stress test. It only looks at cold, hard cash.
But here's where the real detective work comes in. It's the gap between the current and quick ratios that tells the real story. If the current ratio is high, but the quick ratio is low, that's a massive red flag. It means the company is probably way too dependent on selling its inventory just to keep the lights on.
Okay, so the patient seems stable for now. Let's zoom out and look at solvency. This is all about the long-term game. We're asking, how is this company built? Is it standing on its own 2 feet with its own money, or is it propped up by a huge mountain of debt?
We've got 2 go-to ratios here that give us different perspectives. Debt to equity gives you a snapshot of the company's structure, how much debt versus how much equity. But times interest earned gives us a more dynamic view. It looks at the company's operating profit to see if it's actually generating enough cash to cover its interest payments. Because hey, a healthy structure doesn't mean much if you can't make your monthly payments.
All right, let's move on to our next 2 vital signs. We've checked for stability. Now it's time to check performance. How well is the company actually running its day-to-day operations? And maybe more importantly, is it actually making any money?
Think of efficiency as a direct measure of management skill. Are they actually good at their jobs? Are they turning their assets, like all that inventory and equipment, into cold, hard sales? Or is all that stuff just sitting around collecting dust? A classic way to check this is with inventory turnover. You want this number to be high, right? It means products are flying off the shelves. But a low turnover, that's a huge warning sign. It suggests inventory is just sitting in a warehouse, tying up cash. And you know, a real pro analyst knows it's not just about inventory. You also have to check how fast they get paid by customers. A company can look great selling stuff, but if it takes them a year to collect the cash, that's another big problem.
And finally, we get to the one everyone really cares about: profitability. I mean, after all the bills are paid and all the sales are made, is there actually anything left for the owners? This is the ultimate scorecard.
Okay, so we have these 4 different vital signs, but a great analyst doesn't just look at them in isolation. They connect the dots, and that's where the DuPont framework comes in. This thing is like a master key that weaves profitability, efficiency, and solvency into one single powerful story about shareholder value. So, the magic of DuPont is how it breaks down return on equity, or ROE, which is arguably the most important number for any investor. It shows you that ROE isn't just one thing. It's really a combination of 3 different levers you can pull: how profitable you are, how efficiently you use your assets, and how much debt you use to juice your returns. And this table here lays it all out perfectly. It connects each piece of the puzzle back to one of our core vitals. So when you see a company with a high ROE, you can use DuPont to ask, okay, why is it high? Is it because they're selling high-margin products? Are they super efficient? Or is it just because they've taken on a risky amount of debt? DuPont tells you exactly which lever they're pulling. And that brings us to the most important point here. A high ROE can look amazing on the surface, but it might be hiding something dangerous. Is it high because the company is a well-oiled, efficient machine? Or is it just because they piled on a ton of risky debt? DuPont lets you see what's really going on behind the curtain.
All right, now for the secret weapon, the thing that truly separates the rookies from the pros. Numbers in a vacuum are totally meaningless. A ratio of 2 tells you absolutely nothing by itself. You need to compare it to something. Context is everything. One of the biggest traps for any new analyst is the accounting policy. Just imagine two completely identical companies. The only difference is that during a time of rising prices, one uses LIFO accounting and the other uses FIFO. Well, their reported profits are going to look totally different, even if they're running the exact same business. And just look at how this skews the numbers. The LIFO company will look less profitable, but it'll also look way more efficient because its inventory turnover is artificially pumped up. If you don't catch that difference in accounting, your whole analysis is toast. You have to compare apples to apples. Okay, let's bring it all home. You've got the toolkit. Now let's make sure it's sharp. We're going to lock in the key takeaways, and then I'm going to hit you with some real-world interview questions so you're ready to go. If you remember nothing else from today, remember these 3 things. 1. Ratios are clues, not conclusions. They tell you where to start digging. 2. The DuPont framework is your secret weapon for understanding the real story behind ROE. And 3, say with me, context is everything. Always compare to the industry and check those accounting policies. All right, first interview question. You're in the hot seat. An interviewer says, a company's ROE went up, but its profit margin actually went down. How is that even possible? Well, you know the answer, right? It's the DuPont framework. There are only 2 ways this can happen. Either the company became much more efficient with its assets, or it took on more debt. Next question. Your analysis shows a company with a super high current ratio, like 3.5. Is that automatically a good thing? The answer? Nope, not at all. It could actually be a sign of really poor management. Maybe they're hoarding cash they should be investing, or they're just struggling to sell a warehouse full of old inventory. Okay, final question. You're comparing 2 big retail companies, especially in a period of inflation. What's the one accounting policy you absolutely have to check before you do anything else? You got it. It's their inventory valuation method, LIFO versus FIFO. So there you have it. You're not just looking at a spreadsheet anymore. You now have a powerful diagnostic toolkit to decode the story that's hidden in the numbers. So the only real question left is, what story are you going to find?